Well, for more on those earnings that beat from Gannett, let's head to Lydia Thew at the markets desk for the breakdown. Lydia.
That's right, Betty. A big beat for Gannett and those shares rising in the pre-market. As a result, Gannett reporting EPS of 46 cents a share, really beating the consensus estimate, which was 38 cents a share, and also beating the highest estimate, which had been 42 cents a share. Now, when it comes to revenue, coming in pretty much in line at $1.4 billion. Also, want to highlight what happened with advertising revenue, because this is what I touched on before they actually reported. If you take a look at this chart, this is showing Gannett's ad sales back in 2007. Now, we have seen the decline here. However, this was the most recent report this morning, $753 million in total ad sales. That's a little bounce up from what we saw in the first quarter, and the CFO saying in that report that they continue to position the company for the eventual rebound in the economy and the evolving media landscape. She's also pointing out the decline in operating expenses, down 67%. They have done a lot of job cutting, cutting about 1,400 jobs, as we reported earlier this month, and also other, doing some consolidations, some furloughs, cutting salaries as well. So, Betty, this is what investors are taking to be good news for Gannett shares so far. Back to you.
Okay, thank you, Lydia. Well, for reaction, we turn to a media expert who's been named Best of the Street All-Star Analyst for multiple years by the Wall Street Journal. He's Mike Kupinski, Director of Research and Senior Research Analyst of Media and Entertainment at Nobile Financial Group. And Mike, great to have you with us. And what's your takeaway from this report?
Well, actually, it was a good report because what it demonstrates is the company's ability to cut costs. I mean, this is a company that has largely a non-union workforce. It has a flexible workforce, and it has the ability to cut costs. And that's one of the reasons why we like this story here as an economic recovery play.
But that's only good for a few quarters, right? What happens after that?
Well, certainly we have to see some stabilization in advertising, and as the earlier reporter pointed out, at least the second quarter was a little bit better than the first quarter, and so hopefully we're starting to see some stabilization there.
Where do you see ad revenues going, though, Mike? I mean, what are your forecasts? Because I think recently it's been anywhere from down 14% to perhaps down 20 to 30% this year.
Well, we're looking for moderating trends throughout the year. We are still looking for our newspaper advertising to be down 25% in the third quarter, but moderating to 19% down in the fourth quarter. And as we go into 2010, we do think the picture turns a little bit more bright as we get towards the second half of 2010. So we're looking for moderating trends, still down, though, quite a bit.
Why do you see things moderating, or why do you see things stabilizing? What's going to be the catalyst?
I think that you have two things. I mean, we are looking for an improving economic picture in 2010. Also, we certainly, Gannett has a little bit of broadcast operations, and I think that you'll get easier comps as you go into the fourth quarter. Automobile advertising, the fact that GM's now coming out of bankruptcy. I mean, we had very little auto advertising in the fourth quarter of last year when we started to go through our crisis. So the comps get a lot easier. And then also, remember that we're cycling into another political year in 2010. So about 15% of their revenues are going to start to benefit from political advertising again.
But some of that advertising, Mike, I mean, autos, real estate, that's never coming back, right?
Well, it's interesting because I went through, already 3 cycles in my career in following the industry. Everybody doesn't seem to think that the industry is going to cycle back again. And certainly, as we all know, the economy does improve and advertising improves in general. So my viewpoint is that we will see a recovery. It may not be the type of recovery we've had in the past. It may not be as strong in seeing mid-single digit to high single-digit growth. But we do look for moderating trends and an improving picture as the economy improves.
Right, but the question is, okay, if they're not going to be able to rely on classifieds or not be able to rely on real estate or autos to advertise in their papers, then who is the other revenue source then, or who's going to replace that?
Well, look at, let's remember that the newspapers also have a digital component, and so their digital revenues were pretty much in line with expectations, and it's fair and holding up fairly well. And so I do anticipate that overall we're looking for the all of those components to continue to improve. I mean, I'm not going to assume that the circulation numbers look to be holding up pretty well. We're looking for it. There's still a large number of readers that continue to read the newspaper and use it as a source, and for that reason, people are still going to advertise in a newspaper. So to say that real estate's all going to go away, or autos are all going to go away, or even Help Wanted are going to find other means than the newspaper, I think is really a little bit naive, because I do think that this medium is still a very valuable medium to a lot of advertisers.
Okay, Mike, we've run out of time, but thanks so much for talking to us about the newspaper industry. That was Mike Kupinski of Nobile Financial Group reacting to the Gannett results.